My name is Jeremy Kasdan, Sales and Partnerships Lead at FinTech TV, and Taking Stock starts now.
Bye.
In a couple minutes.
Okay. 2 minutes to go here into the closing bell on the trading floor of the one, the only, truly iconic New York Stock Exchange. All-time highs for the S&P 500 and the small caps. Are you not entertained? The Einstein of Wall Street joins us now. So the Dow was down a good chunk of the afternoon session, found its footing. The S&P, the small caps, the NYSE composite, all-time highs.
I think the runway just feels clear, right? We actually had, in absence of bad news, the market's going up. That's the bottom line, right? For the only days that we've had weakness in the market, it was like, just being pounded by stuff out of the Straits of Hormuz and whatever. And so we've got like 48 hours here where there's some economic data that wasn't bad, and there's nothing going on radically in the Middle East that could knock the market off. So it loves to disengage that stuff, which doesn't have economic implications really. Right. I mean, it does, what's going on there, it does per se, but it's not like breaking news type situation. And so this is a beautiful breakout. The runway feels clear, people are buying the market, right? We started the momentum on the Dow just sort of faded and gone back in this territory. The S&P is the one you want to watch on a day like today. The Dow is not as significant, but you're seeing the S&P like 7,800, we just hit it. So these are beautiful numbers. The breadth of the rally is strong.
There you go. We had a CPI inflation print yesterday. In line with expectations. PPI, all things good, at least for today. Sets the stage for Friday.
The economy and the markets, sometimes they're together, sometimes they're separate. Right now, they're supporting each other.
Peter Tuchman, thank you for being
here. The
Nixon
5, baby.
Nixon 5. There you have it, down here on the trading floor of the New York Stock Exchange. The S&P 500 in record-setting territory in the green. Let's call it 0.6%. The Dow finding its footing late in the afternoon session, up fractionally. The New York Stock Exchange Composite Index also in record-setting territory, up 0.2% on this Thursday afternoon. And the small caps, not to be overlooked, up 0.25%, also in record-setting territory. The VIX was up today. The VIX about flat, still under 15. Volatility not top of mind for investors today. Telecom, real estate, staples, the best of the bunch in the S&P 500. The lagging sectors today include materials, healthcare stocks, as well as industrials. More on those names coming up in just a bit. To the Dow we go. Salesforce, the big winner on the day. Merck, as well as retail giant Nike, having a nice session. Cisco down 8.5% today after reporting earnings yesterday after the close. UNH and McDonald's joining Cisco as the biggest lagging stocks in the Dow. 7 tech stocks mostly higher on the day. We did see Amazon give up some of its gains in the afternoon session. Tesla, the big winner, up 3.5%. SpaceX, meanwhile, in the red, 3%. Enough of me chatting on, because this is the man you really want to hear from. Good friend of ours here on the show, Ryan Dietrich, Chief Market Strategist at the Carson Group. And everyone who watches this has been watching you on TV all day today. Thanks for making time for us today.
My face for radio is all over the place.
Dude, it's always awesome to have you. I know you like to say this bull market may in fact prove to be a bit younger than people are expecting. What do you see here in terms of the big picture stuff, Ryan?
Well, first of all, thanks for having me. This is exciting. I mean, is it always like this out here?
They're all for you, and it is always like this at the same time.
This is exciting, yeah. So new all-time highs today, so congratulations everybody. This bull market, JD, is about 3.8 years old, so almost 4 years old this October. That's the 8th longest bull market since World War II. Sounds pretty old, right? But then you look at those other 7, okay, that made it a little bit further. 6 of them made it to at least their 5th birthday, an average of up over 7 years. Now listen, these are just averages, these are just numbers. But when you look at the market, I know you like your technicals like I do, advanced decline lines across the board are hitting new highs. We get into the weeds of the economy and the Fed and inflation, all that stuff. There's a lot of positives, and I think this bull market probably has a lot more tricks up its sleeves. Just because it's about 4 years old, that doesn't mean it has to end tomorrow. In fact, it probably has a year or 2, maybe even longer left.
This despite the fact that the Stock Traders Almanac tells us this is normally the weak spot of the 4-year cycles. We get closer to the midterm elections. What are you seeing going on here for people that are fans of history and maybe expected
Right.
2026 to be a bit different?
Well, I'm a fan of Jeff Hirsch as well, the stocks for his almanac there. You know, this is the midterm year, and historically they're weak, yes, but I think you and I maybe talked about this last time. It's year 6 of President Trump, and I get it, it's not 6 years in a row. But you look at the last 5 presidents that made it to the 6th year, market was up every time, up almost 20% on average. So there's something to think about there. Yes, the third quarter of a midterm year can be troublesome. August and September, I'm a guy that's out there sharing this, usually are 2 of the weaker months. But I think that was kind of pulled forward this year with the big implosion we had in AI and memory and all that stuff in July. You know, I think we're back to your regularly scheduled bull market, and I think, you know, we're probably going to, well, geez, not anything too crazy to say we're going to have a higher August, pretty good start, but I think we can even have a higher August in September to kind of buck the trend, again, with the earlier weakness earlier this summer.
CME Group FedWatch tool says the Fed will do nothing for September, nothing for October, but a hike. Interest rate hike is on the table for short-term interest rates for December. I suspect you maybe see things differently, Ryan Dietrich.
We do, and we were here at Carson Group, and we talked to Sonu last time, so thanks for that. So Sonu and I released our mid-year outlook about a month ago. And our big contrarian take there was no hikes the rest of this year. Now, a month ago, that was almost crazy to say. Now, fast forward a month, and now the odds are maybe they're not going to hike in September. Everybody said we're going to hike in September. People thought 2 weeks ago the Fed was going to hike, and now, of course, they did, and the market had that big 2% drop, and next thing you know, we take off to the races. We're not saying inflation is like great. I mean, inflation's a little stubborn. We had some decent inflation data the last 2 days. But our theme is this: the Fed's going to run it hot. And if the Fed's going to run it hot with no cuts, you probably be overweight equities. That's what we've been for a very long time. We still think that's the case here.
How much are these all-time highs in the market being driven by AI spending, and what happens if and when, dare I ask, that AI spending starts to show signs of pulling back?
Well, you say the Mag 7. I've been running around your city. Mag 7 had a little weak day today, even though the market was up. Is that what we said earlier?
Most of them were actually mostly higher. Amazon was the only one.
Okay, it makes sense. A lot of green out there.
Yep.
I mean, the big thing at the start of this year, you look at all the AI CapEx spending for 2027, expected to be around $600 billion. Now it's over $1 trillion. So these are numbers and stats. We're talking some real money now. You know, JD, this is real money, $1 trillion. This spending, that's about 2.8% of the economy here in the U.S. So that's still there. We don't think it's going to end yet. I mean, you know, one of these days it will, and when it ends, of course that'll be a problem. Of course that might be a lid on the market. We don't think that's the case yet, but that's why we want to stay diversified. It's kind of boring to say, but we've been very diverse. We like to use you know, kind of barbelled approaches. You have some technology over here, but you have some financials and industrials over there, some small over here, some large over there. It's a global bull market. Just don't get too cute with it. Be invested in different parts of it. I think you'll still do really well here.
What is one part of this overall market story that you think we should be paying more attention to? Maybe something we're not quite yet talking enough about?
Well, again, maybe I'll go to the technicals. It's where I go when people ask me questions I don't have an answer for. It's easy. You know, Staples relative to the S&P 500, literally like today, is hitting the lowest level ever. That's a relative basis. You want to see Staples lagging, JD. Back in, you know, June and July, when everybody's talking about how bad everything was and all the trouble, we were pointing this out, that listen, Staples is still underperforming. Back in March, we had a 9.1% mild correction. Everybody's freaking out. Long-term bulls are cutting their targets, all this and that. We never did that here at Carson. And I noted then, Staples are underperforming. If we start to see Staples get a bid, which we're not, I'm going to be very clear, that would worry me. I think that's something a lot of people kind of ignore, but it has been very, very accurate. And with new lows right now, that's back to your regularly scheduled bull market.
XLP Consumer Staples ETF up 10.5% year to date versus, to your point, the S&P's broader gain of about 13.4.
Yeah, so it's up, which is fine. Everybody's making money, but again, it's not up as much, which is what you want to see.
One of our favorite all-time guests and one of my absolute favorites, and one and only Ryan Dietrich of the Carson Group. My man, thank you for visiting us here in New York.
Listen, I've had one piece of pizza so far. My goal is maybe 3 or 4 more. Where should I go? Real quickly, we're on the air. Where would I go for pizza, JD?
Oh, man, you got John's right up the street from down here. John's at Bleecker. A couple locations you can't miss. When in doubt, we got $1.50 slices all around the city.
Well, this is always an honor. Thank you, JD, for having me back.
Thank you for being here. Skylar, grab your mic. We'll talk to you again soon. All right, folks, here are a few of the top analyst calls that move the tape. Thank you, Skylar, this morning here on Wall Street. First up, HSBC upgrading Keurig Dr. Pepper to a buy from a hold. Pardon me, fellas. They say the company has an improving coffee outlook. That sounds good. Excuse me. Shares up 10% year to date. Next up, B of A downgrading StubHub to underperform from neutral, seeing deteriorating growth for StubHub with the World Cup firmly in the rearview mirror. StubHub down 10% today on that particular downgrade. Third and final of the hour, Jefferies upgrading 5 and below to a buy from a hold rating on comp strength. They see accelerating growth for earnings per share and beyond. 5 and below up 40% since July 8th alone. The best performing beer and beverage stocks so far in 2026 are our friends over at Diageo. They trade right here at the New York Stock Exchange, up 10% on the year. Diageo refocusing on some of its strongest consumer-facing brands like Guinness. This comes, of course, on a backdrop of a weak U.S. spirit sales, which are weighing on growth for Diageo. There are certainly industry headwinds. We know that storyline very well, but DEO shares still up almost 20% over the last 3 months. Well, the July jobs report we got last Friday showed unemployment falling all the way down to 4.1%, which sounds great, but many people here on Wall Street are wondering, are there cracks underneath the surface? Callie Cox of Ritholtz Wealth Management joined me this morning on the J.D. Durkin Show to answer that and, of course, a lot more. Take a look. Does the fall to 4.1%, because we can get 4.1% unemployment by different ways. Does the fact that we have more people no longer seeking full-time employment, is that kind of what most stood out from the jobs print we got last Friday?
Yeah, this is a great point that you made just now, because when people think about unemployment, they think about major waves of job losses across the economy. That's not what we're seeing right now. By the way, an unemployment rate of 4.1% is historically low. It's up from what we saw about 2 years ago, but it is still quite low. The unemployment that we're seeing, and you can see this in jobs data if you break it apart, the unemployment that we're seeing is really the unemployment among new entrants to the labor force and what they call re-entrants, dropped out, coming back in. It's not from layoffs, and you can see that pretty clearly in the data. And we're in this weird spot right now where there's little hiring going on, again, because there are fewer workers available, but also, you can make an argument that certain parts of corporate America are struggling at the moment. And we're at the point where NFPs and payrolls are just, there's really an industry by industry story, and it all congregates into a smaller number, but really have to look under the hood to understand what's happening.
You call this job market the Great Wait. Little hiring, little firing. Are you concerned? If so, how concerned? Should we be more concerned?
I said that 2 years ago and nothing has changed. I'm getting a little bored, I'll be honest. We're still in the great wait again, little hiring, little firing, less quitting. I don't know if our viewers can relate to this, but a lot of people are sitting in their job and they're saying, this is fine for now. I don't feel confident enough to step out and find a new job. I'm not getting fired. Maybe maybe I just sit here and bide my time. So that's the labor market we're stuck in. Again, it is really hard to read the job market at the moment, but I'm not sure what shakes us out of this. I would imagine it, nobody can predict the future, but I'd imagine some kind of unforeseen crisis comes in and maybe knocks the economy off its axle. I wonder what can happen from the good side of things. I'm not really sure there. We're just in a really weird environment. And unless something comes in and shakes things up, we may be stuck in the Great Wait for a while.
How are you thinking about resilient consumer spending? I mean, I love the soft data versus hard data conversation. We know how sour so many American people, American families feel, how really the lack of certainty they have in their personal economic situation. And yet you looked at consumer spending, you look at where discretionary stocks are trading here, Callie, it seems as if we have a mismatch. How do you personally square that circle?
Yeah, so I'm going to answer your question. I want to add one more thing about the job market that I actually didn't mention. We are seeing a revival in manufacturing. You can see that in the data. So one good thing that could happen is that revival in manufacturing leads to higher demand and leads to higher or more hiring in more manufacturing related industries, trade, construction, goods producers. We're not seeing that yet, but I will throw that out as a hopeful story. It's something I'm watching quickly or closely. In terms of the consumer, this is really where the pedal hits the metal. Consumer spending is 70% of the economy. Many Americans make their primary income from the job market. This is why I'm so frustrated that you can't read it very well. But consumer spending has been oddly resilient for a really long time, really since COVID and the quick but deep recession that we saw during COVID. A lot has happened since then. The job market has become really hot, then calm down. We've seen a few fiscal packages come out, most recently the OBBBA, which led to higher tax refunds. And it's been a really weird economy to say blanket statements about the consumer. Lower income consumers are feeling some stress. Higher income consumers are too feeling some stress in other areas, but their wallets seem to be a little more diversified. They feel more of this recent stock market success that we've seen. Um, Again, stable but fragile in a way. Something could come in and shake things up, and we could see layoffs very quickly. This economy has been pretty battered throughout the last 4 years, and while it's resilient, it still does worry me that the base below it is possibly thinning out.
Welcome back to the show, live here on the trading floor of the New York Stock Exchange. Carlos Domingo joins us now. He is the CEO at Securitize. Carlos, thanks a lot for taking the time. You just reported your very first earnings call as a publicly listed company. Talk to me first and foremost about the top line takeaways you want investors to keep in mind.
Sure. So we just announced our first earning quarter. The AUM in our platform was up to $1 billion to $4.3 billion. And shortly after, we actually, raised to $5 billion, which is a record for us. From a revenue perspective, we have $14.4 million. We came from a record quarter, the quarter before at 19.5. So overall, the industry continues, making progress. The transactions are up like 149% in our platform. We, review the partnerships announcements we did with Computer Shares, with Continental. As you guys know, after we went public in New York Stock Exchange, we tokenized our own stock and make it available on chain. So overall, it was a very busy quarter, and we made a lot of progress.
Tokenized assets continue to hit record level after record level. What are some of the biggest factors that are driving that growth, Carlos?
I think we're seeing a lot more institutional adoption coming. This is an important thing because we're kind of like decoupling a little bit from what was initially the tokenized economy, which was mainly consumed by the crypto ecosystem, which is a good thing. While some other parts of the market, like crypto, is down almost 50% in the highs in October. Stable coins are flat, but tokenized assets continue growing significantly, and we still think that we're in the very, very early stages of the industry, and there is a lot of growth ahead.
Are there particular assets that you see highest levels of interest from investors in terms of eventually putting on chain?
The two areas that we're focusing are, on one side, yield-bearing assets, all the spectrum that goes from tokenized treasuries, which is the largest category, where we have a leadership position with our partnership with BlackRock, where during the quarter we announced the second tokenized treasury fund with them, all the way to any yield-bearing assets, bonds, credit, etc. So that's one particular area of focus. The other one that there's a lot of interest in the industry, but it's still very, very small, but which is tokenized equities and ETFs. This is a massive opportunity because it's a huge market at a $100 trillion plus size that only 2% of it moves on chain. It will basically double the size of the entire crypto market.
Big banks, asset managers, all the so-called smart money here on Wall Street, are you seeing them finally moving away from experimentation with tokenization to actually doing it?
I've been in this industry longer than anybody else, I will argue, because our platform was one of the first ones almost 9 years ago. And I can tell you, I've never seen more interest around tokenization coming from large both asset managers as well as banks. Every single one that we talk to has a full team now looking at the space, and it's a matter of time whether all of them come full-fledged into the market.
You tokenized almost $300 million of your own stock. Not many companies can say that. Why did you do it, and what did it prove?
So actually, no other company can say that. We were the first one that actually did that on listing day, of having simultaneously our shares available through the New York Stock Exchange as well as on chain in tokenized format. The reason we did it was obviously to showcase the capabilities, to also prove to the market that this is something you can actually do in a regulated way in the US, that you don't have to go to do it offshore and create derivatives or other type of synthetic instruments. It was a great showcase. It became the largest tokenized equity in the industry overnight, and we're very proud of it, and we hope that many other companies will be doing the same thing moving forward.
Carlos Domingo, CEO of Securitize, thanks a lot for taking the time. Great to get your perspective.
Thanks for having me again.
We'll do it again soon. Folks, don't go away. A lot more Taking Stock coming up on this Thursday edition of the broadcast right after this. Welcome back to the broadcast. Joining me now down here on the trading floor of the big board is Holly Framstead, head of global product at Capital Group, who just got through ringing the one and only closing bell. Nice to see you. Thank you for taking the time.
Thank you. It's great to be here.
What does ringing the bell today mean for Capital Group's ETF business? And ultimately, what are you really here to celebrate?
Well, we are here today officially celebrating our 12 Morningstar Gold ratings on our actively managed ETFs. Really, I think this is a testament to the capital system and our unique form of fundamental active management that focuses on long-term perspectives, diverse points of view coming together, and deep research helping drive those investment decisions.
Of course, we're also big fans of Morningstar. You got additional Morningstar recognition. What does that look like, and what does that mean to you?
Indeed, I think it really is a testament to how we manage money. When you think about the stock market today, it's incredibly concentrated, in particular in the AI theme, and our ability to break through that noise, bring broader diversity to a portfolio, makes active management suitable at the core of a client's funds.
Capital Group was built more on mutual funds. Why move into ETFs, and how are you viewing this new iteration of your work?
Well, active ETFs can be incredibly tax efficient. So for taxable investors, they're a very powerful vehicle. Historically, you only had access to index management or passive management in that wrapper. And now that you can access actively managed investment strategies in the ETF wrapper, investors are now bringing their money back to active management. What we find is that ETFs have taken 3% market share from mutual funds in model portfolios across the industry, and 2 percentage points of that are going into actively managed ETFs. So increasingly, financial advisors are demonstrating the value of ETFs and appreciating the value of active combined.
What are you seeing overall in the ecosystem in terms of investor appetite for ETF products? I've been doing this a long time, and just more, I can't go very many minutes within my day without having an ETF conversation, and understandably so.
Well, investor appetite for ETFs is tremendous. They've been growing at about a 20% compound annual growth rate. Importantly, though, actively managed ETFs are growing at a roughly 50% compound annual growth rate. So far faster than their passive counterparts, and we think this is a testament to the broadening of exposures available in the vehicle.
Passive investing can still be so dominant to so many portfolios. What is the case for more active management today, to your point?
Well, some of the risks that we see in the market today are the heavy concentration, in particular in the AI theme and in markets overall. If you think about the top 10 companies in the S&P 500, represent about 40% of the overall index. In semiconductors alone in the S&P, it's 20%. And the concentration isn't just a US phenomenon. If you look globally, MSCI Emerging Markets Index, the top 3 names account for about 30%. So that's a tremendous amount of concentration in a single theme. And we think active managers have a better ability to parse through the market noise, bring broader diversification, and ultimately protect their clients in the event of a market regime change or disruption.
Holly, as you and I are sitting here, I can look up, I see all these impressive ticker symbols up here next to Capital Group. We got CGXU, CGNG, many others. If you got people watching the interview, they want to learn more, they want to become more informed investors, where do you recommend they start to be introduced to some of these products?
Well, capitalgroup.com is certainly a place to access information on the products, but most importantly, we think you should consult with your financial advisor. We offer more than 25 ETFs in the US, 29 now, that are really suitable for the core of a client portfolio, and we're expanding globally. So if you're looking for an exposure to build a more tax-efficient asset allocation, we probably have an ETF for that, and consult your financial advisor or capitalgroup.com.
We had an incredibly enthusiastic closing bell down here today to celebrate you and the markets, and you brought us all-time highs. Thank you for that as well.
Thank you. I wish I could say I had anything to do with that.
I'm going to give you the credit. Why not? Holly Framstead, head of global product at Capital Group. Come back anytime. It's nice to see you.
Very great to see you too.
All right, don't go away. A lot more Taking Stock coming up on this Thursday from the big board right after this. Welcome back to the show. And now Money 2020's very own Scarlett Sieber is back with a whole new edition of Jargon Translator, where she puts complicated, very wonky finance terminology into everyday language that truly anyone can understand. Have a look.
I'm Scarlett Sieber from Money 2020, and this is Jargon Translator, where we slow down the terms that usually get blamed after something breaks. Today's term is liquidity mismatch. Liquidity mismatch happens when the timing of your assets doesn't line up with the timing of your obligations. In plain English, you owe money sooner than you can get it back. Your assets might be valuable, they might even exceed what you owe, but if they can't be turned into cash quickly enough, you're left exposed. This is one of the oldest failure modes in finance. Banks borrow short and lend long. Funds promise daily liquidity while holding illiquid assets. Companies rely on rolling financing instead of permanent capital. As long as confidence holds, liquidity mismatch, it stays invisible. When confidence breaks, though, the timing becomes everything. This is why crises often look sudden. Nothing new was discovered. The clock just sped up. Liquidity mismatch explains why solvent institutions can still fail, why temporary funding freezes turn existential, and why central banks focus on liquidity, not value, in emergencies. It's also why stress tests obsess over timing, not just totals. Let's fast forward to today. Liquidity mismatch still exists. It's just better hidden. Inside funds, inside fintech balance sheets, inside markets that assume liquidity until it disappears. Liquidity mismatch isn't a mistake. It's a design choice. And managing it is a difference between surviving stress and becoming the stress. That is your jargon translated. If there's a finance term you want broken down before it shows up in the headline, drop it in the comments and it might just make the cut. In the meantime, back over to you.
Tomorrow here on Wall Street, the latest University of Michigan preliminary consumer sentiment survey data for the month of August crosses the wire at 10 a.m. Tomorrow is also National Financial Awareness Day, something we could all celebrate. Thanks for watching this Thursday edition of Taking Stock. Have a great night. We'll see you again tomorrow.